Hello, everyone, and many thanks once again for tuning into another of our investment videos. This week's video is a bit special. Against the backdrop of steepening bond yield curves and the spectre of rising inflation, one fundamental asset class is never spoken about, in the UK anyway. Well, today that changes. I have the absolute delight in talking to Mr. Eli Pars, co-CIO, Head of Alternative Strategies, Co-Head of Convertible Strategies, and Senior Portfolio Manager at Calamos Investments in Chicago. And today, Eli is going to explain to us all the fundamentals of convertible bonds and why this could be perhaps the most important time in history to own the asset class. Big enough intro? I think so. But before we start, it would be fantastic to receive your support for the channel by subscribing. We deliver regular content covering all aspects of financial and investment planning videos, so turn on that notification bell to ensure you do not miss out. Anyway, let's get down to the contact. Eli, first off, it's a huge pleasure to talk to you today. Thanks very much for your time. Convertible bonds are not a common asset allocation in the UK. So for those viewers who are unsure as to what they are, can you give a brief outline of them, please?
Sure, it's great to be here. Thanks. Yeah, a little bit about convertibles. First and foremost, convertibles are a bond. So, a new issue, you buy it at par at 1,000, you hold it for a term, receive coupons along the way, and it redeems at par. And has that same fixed income components and credit components of a regular corporate bond. What's different is it also has attached to it an option, and it's your option to convert into stock. So it's basically, if you think of it as a 5-year call option stapled to that 5-year bond, it creates some really interesting performance things for you, where if the stock does well, you benefit to the upside from the upside performance of the stock. If the stock's sideways or down, you basically benefit from owning a corporate bond. It can really be kind of a heads you win and tails you don't really lose much proposition for investors. It's a reasonable sized asset class, around 500 billion globally, but not huge. And I think that nichiness sometimes creates some opportunities for investors that maybe wouldn't be there if everyone was focused on the strategy.
Yeah.
On a portfolio basis, convertibles done right can create, over a whole market cycle, equity-like returns with less volatility. That's really the attraction, I think, is that long-term strategic approach to convertibles. And what's tricky is you really need to manage that. So think about an example. You buy a bond at par, the stock works, bond all of a sudden is, stock's up 2 or 3-fold, the bond's in the 200s. At that point, it has this similar upside downside profile as equity. It no longer has that downside protection of the bond because you're 100 points away from your bond price. Needing to sell that and rebalance your portfolio is why active management is so critical in converts, because in a passive strategy in a bull market, it works great. You're participating on the way up. But all of a sudden the market sells off 10% and you're down 8 or 9. And you're like, why did I buy these convertibles? They're just like equities. Well, if you don't actively manage them, they really can be just like equities at different times. And that's why it's important, and why we focus so much on rebalancing and keeping a good risk reward in the portfolio, because we don't know what tomorrow's going to bring. We want to be positioned so if the market does well, we do well. If the market sells off, we cushion the blow for investors.
Mm-hmm. Calamos are renowned as global convertible specialists. What differentiates yourselves from your peers?
Yeah, we've been doing this a long time. John Calamos was one of the pioneers in the convertible space back in the early 1970s. And is still active today. He's in the office every day as our founder and co-CIO of the firm. I think where you see us different, particularly from a lot of the European convertible managers that you're more likely to run across every day in the UK market, is we're much more comfortable. Well, a couple things. We're much more comfortable as kind of a low volatility equity allocation. So we want to manage the portfolio to get good upside participation with good downside protection, but we want to we want to get that equity market return over a whole market cycle.
Mm-hmm.
Some of our European competitors are more enhanced fixed income, just, really looking at it from a bond perspective and trying to add some value to that, which at times and historically has been a nice way to do converts. It's kind of tricky in a zero rate world. It's just, you end up with structures where it's hard to make money.
Yeah.
And I think we're seeing that in some of the performance of some of the more fixed income oriented convert shops.
Mm-hmm.
Also for us, we're comfortable in some of the lower end of the credit curve in converts, which is a key part of the market. A big part of the convert market's non-rated. And the reason it doesn't get a rating is because it usually doesn't have any other funded debt. They don't have any syndicated bank debt. They don't have any high yield. So from a credit standpoint, they're not bad companies. They're just not seasoned. They haven't been around a long time where the rating agencies are comfortable giving them an investment grade rating. But the experience in those actually is quite good. And, doing the in-depth research that we do and all the names we own, we can get that comfort level and the differentiation between the names we want to own and the names maybe we don't.
Mm-hmm. Why? Well, basically looking at the current market and considering steepening bond yields and the real pressures that fixed income investors are facing at this moment in time, why should investors consider convertibles at this moment in time and maybe for the first time ever looking to introduce them to the portfolio?
Yeah, there's, one of the nice things about converts is they typically do well in a rising rate environment. You go back through history and periods where the 10-year treasury yields moved up 100 basis points or more. And typically, in every case, converts outperform bonds because converts are typically shorter duration. Right. The typical convertible and new issue is a 5-year bond, but because of the embedded equity option, it has the duration of a 3-year bond. Mm-hmm. So just that bond math alone, they're going to do better in a rate move than most fixed income, products are going to do. But what's more interesting is in most, if not all, and I think every case but one over the last 30 years, convertibles were actually up when the bond market was down in those rising rate environments. And the reason, because the equity market has done well and the equity side of the convertible carries a day. And that's one of the interesting distinctions with high yield is people think of high yield having equity, a piece of equity risk, right? Or higher volatility part of the bond market, but it's a correlation trade. Convertibles have an actual call option inside them. If the stock goes up, the convertible is going to go up. High yield, when you're looking at that correlation with equities and say, oh, if the equity market's up, high yield's up, I can go all through history and look at all these examples. So many of those examples were when high yield coupons were 8, 10, 12%. Now with high yield coupons at 4, something like that, where's the yield compression going to come from? If the or spread compression, if the govy market backs up a little bit, high yield's going to have a hard time just keeping P&L flat and just earning your coupon. And we don't expect a lot of defaults, and with all the money that's been printed and the economy starting to turn around, you're probably going to have decent credit experience. It's just if you get a backup in rates, I'm not sure where the rest of your return comes from in the high yield market.
Yeah.
Whereas converts, I think, can do quite well in a rising rate environment, particularly one that seems to be staple to a rising equity market, which seems like we're likely to get over the next year or two.
Yeah, and we touched on earlier the concern that I've always had was that high yield bonds seem to be the default option, and where rates are at this moment in time, where effectively pricing in zero defaults, it just feels a bit, the risk doesn't seem right at this moment in time. It seems a bit one-sided. Just to finally wrap this up and kind of looking closer to home, why is it that the UK just have seems to have overlooked convertibles as an asset class?
Yeah, I'm not sure. There's a couple of things to think about. I mean, it's kind of interesting because you go back 25, 30 years ago, and there was actually a very active UK domestic convertible market. They used to see paper in, but that's pretty much gone away. And I don't know if that was tax driven or what kind of created that change in the market. But you haven't had a lot of UK companies in recent years come to the convert market. I think that's one thing. So you don't see the local participants that kind of attract people's attention. The other part is, like I mentioned, it's not a giant asset class.
Right.
So to the extent you're talking about some of the big consultants out there, if you're a young analyst at one of the big pension consultants trying to make a name for yourself, and you think, wow, these convertibles are interesting, I can get equity-like returns with less volatility, this fits well for a long-term focused investor. And then you're like, oh, it's 500 billion asset class. If I want to get my clients to put 3% in it and I buy 20% of the asset class or whatever the math works out, and you move on and look at something else. I think that nichiness of it is it's one of the opportunities, but I think it's one of the reasons why you haven't seen as many investors as active in the space in the UK as maybe there were in prior markets.
It's interesting because you tend to find that it seems to be the other way around. The large institutional investors drive the themes that are successful. So maybe this is one for the smaller investor. I don't know. It could be very interesting. And certainly looking at the backdrop of the market at this moment in time, it does feel like you can have both your cake and to be able to eat it with convertibles, but we'll see. Eli, it's been an absolute pleasure. Thank you once again for your time. Thank you for all the conversations with your colleagues at Calamos. It's been fascinating for myself looking at this asset class for the first time since I passed my exams in it. Put it that way. Thank you very much for your time once again. You stay safe, and I'm sure we'll catch up soon.
Great. Thanks so much for your time. Appreciate it.